Hey trader, welcome to a new chapter in our Smart Money Concepts course. Today, we're diving into top-down analysis, a powerful framework for using multiple timeframes to build clarity and structure in your trading. This approach helps you identify market direction, spot liquidity zones, and align your trades with institutional flow. You'll see how to validate key areas, draw precise supply and demand zones, and apply smart money logic from the top of the chart all the way down to your entry. So if you like this kind of video, please like, subscribe, and turn on notifications. And join the ComLucro community to support the channel and keep improving as a trader. Now let's get into it. So, what is top-down analysis? Top-down analysis is a technique that involves examining multiple timeframes and market factors to gain a comprehensive understanding of market conditions. By starting with higher timeframes and gradually focusing on lower timeframes, we can obtain a clear view of market direction and identify key areas at various levels. However, it's important to note that starting from the monthly timeframe and trying to apply every single concept can clutter your chart when you reach your entry timeframe, making it ineffective. In this video, we will guide you on exactly what to look for in each time frame to conduct a well-informed analysis of any chart with ease. But first, why do we even need to combine multiple time frames? Well, here are the top 3 reasons. Number 1, overcoming directional confusion. On the 5-minute chart, the market often appears choppy with no clear direction, continuously violating structure levels, both upwards and downwards. This can confuse any trader trying to identify the trend. However, if we zoom out to the 1-hour time frame, the market trend and bearish pressure become evident. This area is the same as the one observed on the 5-minute chart. By knowing the higher time frame directional bias, we can confidently take short entries on the 5-minute chart. Remember, if you are confused about the direction and the market keeps violating key structure levels, you're likely focusing on the wrong time frame. Analyzing the bigger picture helps enhance your ability to make more precise and confident entries. Number 2, increasing accuracy. A minor reaction to a higher time frame key level can lead to a significant trend change in the lower time frames. Before placing any trade, we should check how much room we have before reaching a higher time frame supply or demand area. This will help us understand how to set our targets, stop losses, and avoid losing trades. For example, on the 15-minute chart, we saw a strong bullish move with a clear fair value gap between the shadows, resulting in a valid order block, a great opportunity to go long. However, the market suddenly changes direction, ignoring the demand order block. Zooming out to the 1-hour time frame reveals that this change could be due to reaching a higher time frame key level that acted as strong resistance multiple times. Checking higher time frame key levels helps avoid unnecessary risks. Conversely, in another 1-hour time frame example, a move with obvious inefficiency breaks above the previous market structure. If the price pulls back to the order block zone, it offers a perfect opportunity to enter a long position, set a stop below the swing low, and target the next market structure level. On the 4-hour chart, we recently broke above these supply areas, indicating that demand is in control with enough room to reach the next unmitigated supply area. Combining higher time frame levels and directional bias with a lower time frame entry setup can make for a perfect trade. Number 3, optimizing trade entries. Analyzing multiple time frames allows traders to identify optimal trade entry and exit points. For instance, imagine waiting for the price to pull back to the order flow area and opening buys to align with the bullish momentum. Setting buy orders at the beginning of the zone may result in a large stop. An optimal way to trade is to look for confirmation and open longs in lower time frames. This confirmation helps get into trades at a better price, reduces the likelihood of false signals, and increases the trader's confidence in their analysis. Now that we've discussed the importance of multi-time frame analysis, let me guide you through our top-down technique step by step. This is the best way to combine higher and lower time frames to build a clear, well-informed chart analysis and identify the best trade opportunities. We consider three types of time frames in our chart analysis, starting from higher time frames. First, we have the weekly and daily time frames, which we use only to identify key levels of the market structure. Second, we use 4-hour and 1-hour time frames for most of the analysis, including identifying market direction, supply and demand areas, order blocks, liquidity zones, and trading opportunities. Third, we use 15-minute and 5-minute timeframes if we need more confirmations and entry reasons in lower details. Now, let's apply these concepts to the real chart of multiple pairs to fully understand this technique. Here we have, on the weekly time frame, in the first step, we mark the key levels of market structure that the price has recently reacted to. We want to keep our analysis simple, so we only draw the most recent levels near the current price. For example, this level is our historical top, which has recently rejected the price twice. We have another key level in front of the price, which has acted as support multiple times. Also, we could draw another key level here. This is the only information we need from the weekly time frame, the key levels of market structure that have a high probability of causing the price to react when it taps into them. So let's zoom into the daily. On the daily time frame, first, we adjust the weekly levels to get the greatest number of touches from the daily perspective. Second, we draw the daily key levels of the market structure with another color. This distinction allows us to differentiate between weekly and daily levels when we zoom into the lower time frame, since higher time frame levels hold greater importance. Now, this is all we need from the daily time frame. But remember to keep three things in mind when drawing levels of market structure. First, draw levels where you can get the greatest number of touches. Second, prioritize drawing from the bodies of the candles. Third, treat the levels as areas, not solid lines. Additionally, there are 5 criteria we look for when identifying key levels of market structure, each making a level more powerful. Turning points. These are areas that have previously reversed the market trend. The market sees these areas as overvalued or oversold, increasing the likelihood of a reaction when the price reaches them again. Multiple rejections. Multiple rejections from an area show that traders took action at the same level at different times, making it more powerful. More rejections are better, but they don't guarantee the level will hold. We closely watch price action to see if rejections are getting weaker, indicating a higher chance of breaking through. Acted as both support and resistance. If a level has acted as both support and resistance previously, it increases the probability of the price rejecting this level again. Drastic move away. A significant move away from an area, indicating a true reversal rather than a minor reaction, makes the level more important. Recently respected or created levels. Recent levels in front of the price are more effective since they are current and new, whether they are traditional support and resistance or order blocks. Now, with all that being said, let's zoom into the 4-hour time frame to continue our analysis, where smart money concepts come into play. On the 4-hour chart, we have both weekly and daily levels visible. Each of these levels can act as strong support or resistance when the market reaches them. We use these levels in 2 major ways. First, breaking each one to the upside or downside indicates whether supply or demand is in control, and if the price can continue pushing to the next level. Second, we use them as higher time frame targets for our trades. On the 4-hour time frame, we fully apply smart money concepts, including identifying market direction, supply and demand areas, order blocks, fair value gaps, liquidity zones, and possible trade opportunities. Here, the market has recently broken below a key daily level with momentum, indicating that supply is in control. Currently, we have an inefficient move that created a fair value gap and a break of structure. So, the candle that created the inefficiency is our order block zone, which could provide a possible short entry. However, we cannot place sell limits on this order block since the price has rejected a key daily level, potentially marking a turning point for a short-term downtrend. Therefore, we need bearish confirmations in lower time frames, like 15 minutes, to enter short positions. Conversely, if the price breaks above both levels, it indicates a strong bullish momentum, which could drive the price up to test the weekly level again. Let's zoom into the 1-hour time frame to continue our analysis. We fully apply smart money concepts here, identifying market direction, supply and demand areas, order blocks, fair value gaps, liquidity zones, and possible trade opportunities. Knowing that the higher time frame directional bias is bearish, we expect the price to get rejected from the 4-hour time frame order block after mitigating this daily zone. The market is making a deep retracement and creating liquidity zones before reaching the 4-hour order block, which serves as another confirmation. Right now, the price is in a short-term uptrend, and the ideal situation would be for the price to change direction, aligning the 4-hour and 1-hour charts in the same bearish direction. So far, we've applied price action and smart money concepts perfectly on the charts, and we have a 4-hour order block, which is an area of interest for trading. It is important to note that for a 4-hour time frame order block, we look for confirmation on the 15-minute chart, and for the 1-hour time frame order block, we look for confirmations on the 5-minute chart. Now, the 15-minute chart is the last time frame we will analyze in this process. In this time frame, we only look for confirmations and entry positions. First, we need the price to enter the order block zone and create a change of character to confirm that the short-term uptrend is over and the market can continue pushing downwards. If we see no change of character, we won't take any trade. Our first target would be the daily level in front of the price, and if the market manages to break this area, it can continue pushing downward to reach the next weekly level in front of the price. Now, this setup was just an example of how to enter a trade, and you could use multiple price action or smart money strategies to enter the market. But remember, before using any setup with your real account, you should backtest it on different pairs to evaluate the trading strategy's performance using historical data. Backtesting allows traders to build the necessary confidence and prepare for potential risks associated with their strategies, optimizing their trading approaches by fine-tuning parameters and rules. Now, let's apply multi-time frame analysis to another pair to fully understand the concept. Let's continue our analysis here on the weekly time frame. These are the only visible weekly levels near the current price, so we draw them in. Now, let's move on to the daily. In this time frame, we first adjust the weekly levels to get the greatest number of touches and draw additional daily levels if they are obvious. Now, let's jump into the 4-hour. Here on the 4-hour chart, we have a bearish bias. After mitigating this daily level, the market has made a deep retracement to this order block zone. So here are two scenarios. If lower time frame price action shows bearish signals at this order block, we could go short, with our primary target being this daily zone and our secondary target being the weekly zone. On the contrary, if the market manages to break and close above the order block, our 4-hour directional bias will change to bullish, and we expect the price to reach the daily and weekly levels in front of the price. Now, let's zoom into the 1-hour time frame to observe more details. Here on the 1-hour chart, we can see a lot of price action signals. After mitigating this 4-hour order block zone, the market made a change of character, signaling that the short-term uptrend is over and the price can possibly continue pushing downwards. Here, we have a perfect opportunity at this 1-hour order block to go short, with our first target being this daily level. And we could use this weekly level as our long-term target. Right now, there's no need to look for confirmations in a lower time frame, unless someone wants to look for more trades based on the analysis we made. But remember, more trades do not mean more profits. To wrap up, let us take a moment to close this section with clarity. Mastering top-down analysis is not just about identifying structure. It is about creating a repeatable and objective decision-making process. When you learn to combine multiple time frames, validate key zones, and align your trades with smart money logic, you trade with far more direction, confidence, and purpose. Before we finish, it is important to reflect on one essential point about emotional management. Many traders fail not because of strategy, but because they underestimate how losses influence their mindset and decision-making. What happens inside your mind during a drawdown matters far more than the loss itself. To reinforce this idea, we are going to show a short clip from our video, How Beginners Can Learn the Discipline of Millionaire Traders. In this clip, you will see the first 2 foundational steps to develop a millionaire trader mindset. even though the full video goes much deeper into the complete process. Let us take a look. Step 1 is awareness. Change begins the moment you notice yourself. Awareness starts in that split second before you click buy. Ask yourself one question: logic or impulse? If the answer comes from emotion, the outcome is already decided. Research from UCLA on affect labeling shows that naming an emotion reduces its intensity. When you name what you feel, you take back control. Awareness breaks the loop. It is how you stop trading for stimulation and start trading for mastery. Step 2, replace the reward. This is the mind reprogramming. Most traders celebrate profit, but professionals celebrate discipline. When you say, nice, I made $100, your brain releases dopamine for the money. But when you say, nice, I followed my setup, your brain releases dopamine for control. You are teaching your mind to feel good, not when you win, but when you do the right thing. And as authors like Mark Douglas note, discipline is the real flex. This is how you rewire the reward system. You make consistency feel like victory. That clip is a timely reminder that consistent results come from discipline, not emotional reaction. The best traders stay grounded, keep structure, and treat trading like the serious performance activity it is. Please also remember that our mission here on the ComLucro channel is to give traders the clarity and confidence they need to make smarter decisions in the market. Every video, every course, and every piece of content we create has one clear purpose: to deliver practical, easy-to-apply knowledge that helps you grow step by step as a trader. Here on the channel, you'll find complete courses on smart money concepts, technical analysis for day traders, and trading psychology. Because trading isn't just about charts, it's also about mindset, discipline, and risk management. We also share lessons and insights from some of the most respected names in trading, professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others whose experience has shaped the way we understand the markets today. If you enjoyed this video and found it helpful, please give it a like. It really helps more traders discover our content. And don't forget to subscribe and turn on notifications so you never miss our latest insights and strategies. If you'd like to go even deeper and access exclusive content, early video releases, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support our work and a smart investment in your own growth as a trader. Thanks for watching, and I'll see you in the next video.